Hello, today is the 2nd of May, 2011. Welcome to the Silver Log. Try to make sense of these markets. I don't know how much sense that it makes when we hear that the fall in silver was due to Osama bin Laden dying. When the news reported that feature at 9:30, the crash started at 6:25 New York time. It doesn't make sense. And you know that this is a roller coaster, it's very volatile, and having a move of about 14% from top to bottom, or maybe even 12, it went down about 6, going from 48 to 42. That's about 14%, yeah? And that's pretty massive. So now what's happened since? It found support at this 20-day moving average. It also coincided with a significant Fibonacci level from the 31 or 30 from the March lows, basically. And it came up to this Fibonacci point, the one from it works out to this high. I suppose you could do it from this one, or this one also, but I like to use this one in here, and it worked out well. This is the one I put on the blog last night. It found resistance, found a higher low. Whenever that happens, when you find a significant area you're supposed to, you pull back, you find a higher low, and then you start to see this pattern. You get the sense that it's got a much better chance of breaking through it. You get extremely enthusiastic as a bear saying, haha, good luck getting through this one, baby. And a lot of times they don't. But they're not as enthusiastic here. But it pulled back and they weren't as enthusiastic as it broke through. And that basically goes with the theory. The more often support and resistance is tested, the more likely it's going to be taken out. Perfect support back at this level. Perfect resistance here at Fibonacci and at the 5-day moving average. All rallies right now are pretty much guilty until proven innocent, but in this case, no. The 5-day moving average did an instant switchover, so that made it in an intermediate term market to be bearish. But it's unprecedented to have that first test of a declining 5-day moving average after this type of accelerated down move to occur in less than 24 hours. That is not normal. This is making the intermediate trend neutral now. The 5-day moving average, as long as the market continues to trade within this average range, it's going to stay flat. And when that's the case, the intermediate term trend is that of lower. Or excuse me, sideways. If it breaks below, it's lower. Maybe this is me instinctively saying it's going to go down. I don't know. I wouldn't count on that, though. At least I wouldn't bet on it for that reason. As far as some significant resistance areas is concerned, this one has been the established. I think this is the most established one. And I mean, now, how do you create a parallel line with this? Maybe this one in here now. I don't know. It's tough to say. And also, one thing I was talking about a few other times recently is a significant top and a significant bottom. And I said this one was so big that it overshadowed its previous one. And another overshadow, boom to boom. And we could overshadow this again later on, but don't count on it, but don't be surprised either, basically. Now, as far as failed moves, if of course it can get above this level in here, the 46 and 3/5, we'll say, and make a break above, then that would be an extreme failed move. If this does fail, what this means is oftentimes you get a fast move from a failed move. Now, if a failed move is an extreme level, I would put logic on stating the fast move to be on extreme level. If it's not a failed move, at least not yet, then the most likely scenario is that you would have a significant top again in here where you would, if you found support here, you'd probably come back to 46, test 45, break it below, then maybe come back down towards this 20-day moving average, and then you'd start your next wave lower. That's if the selling is the correct play, and of course that would be an intermediate term bear market. Not shown on this chart is the 50-day moving average. I look at the 50 on the daily chart like I look at 5 on the short term. Therefore, on the short term, if it does go lower and that makes this the bear market, all rallies are guilty until proven innocent. But with the 50 rising, still well below here, because if this is a 20, it's definitely above the 50. And That's what is the big indicator for the daily chart, not shown on this particular video. Because on the daily chart, all sell-offs are guilty until proven innocent. Therefore, long term, this entire selling was guilty. And within this one here, it was guilty till about down here. Because at some point you got to state when's enough. Because a lot of times you come down to a significant level and you find support, but support doesn't always happen right on it. In fact, a lot of times it's a pretty good pierce, as you can see in here, a little pierce above in here. This is very common to occur. But when the pierces start to not to become pierces, then you got to state, okay, enough's enough. When is this going to turn into an intermediate, or when is it now an intermediate bear market? The fundamentals, of course, nothing is changing. Things are really, this is the type of movements you would expect to happen when you're going to have massive days, 20, 30%, 15% up days. A lot of times you have to shake out early. Now, I'm not saying that's the case, but what I am saying is the same thing I said over the weekend. It's either going to be with this high volume and volatility, either the intermediate term top, which shows signs it could possibly still be that, or that of an explosive up move. And when we see what if this failed move would be, it would just be coincidental that it would all work out. And they're really, to me, I don't believe in much as a coincidence, but there seems to be a lot more of them. Alrighty then. Don't think there's much more to go over. This is the key levels though. So 45 spot, 46 in high change. Take care.